When the hero falls, we all root for them to get back up. But when a stock falls from grace, investors head for the exits. There is a reason to believe, though, when a stock falls out of favor, maybe that is the best time to buy. 39 companies have been kicked out of the Dividend Aristocrats since 2008, and while the stock performance is horrible in the year prior, many of these outperformed the market afterwards. For example, Eli Lilly, ticker LLY, fell from the Aristocrats list in 2009 when, after more than 40 years of increasing its dividend, the company decided to hold the payout constant. Shares struggled in 2009 even as the market bounced back from its crash, but then went on to jump 18% in the next 2 years and 23% annual return since. And I found 5 more fallen aristocrats that should be on your list. First on our list, RTX Corporation, ticker RTX, with its 3.3% dividend yield, just fell from the Dividend Aristocrats last year, though the company has continued to increase its payout. RTX is still in the S&P 500, but has been dropped from the Dividend Aristocrats ETF, so it's not clear what's going on here. Now, the company did recently change its name from Raytheon to RTX in a rebranding to emphasize diversification in aerospace as well as defense. In fact, on the right here for 2023, the Collins Aerospace segment accounts for the majority, 66% of the company's expected operating profit, and is growing the fastest. On the left, we see management expects sales growth as high as 10% this year and report about $5 a share in profits. In its dividend history, we see RTX has increased its dividend by about 5% a year over the last 5, but the shares are down 12% in the last year on a recall of Pratt & Whitney engines. Despite that recall, shares have produced a 6.7% annual return over the last decade and now trade for an attractive 19 times price to earnings. That is a discount of 37% from the 5-year average multiple. On $5 a share earnings, the company is paying 47% of its profits out to cover that dividend, which is sustainable and leaves room for dividend growth. Now, the company has said that the recall will impact revenue by about $5 billion, but won't change the long-term outlook. RTX is one of the largest suppliers of aircraft components and systems, as well as a leading defense systems contractor. The defense segment is the slowest growing here, and even that is mid-single digits growth, while the other two are still growing at double digits a year. So here, investors have the opportunity to grab a reliable dividend stock, beaten down by recent news, that will continue to cash flow for your portfolio. The Dividend Aristocrats are the stocks in the S&P 500 index that not only pay a dividend, but have increased that payout for at least 25 consecutive years. I like to use the ProShares S&P Aristocrats ETF, ticker NOBL, here as an example because it invests directly in these stocks. The fund adjusts each year, adding any new stocks that make the list and then dropping those that couldn't make the cut. It's got some great companies here like Clorox, Walmart, and Kimberly-Clark. The group pays a 2.4% dividend yield, which is 20% higher than the broader market average, that S&P 500, and is surprisingly well diversified across sectors. You can see here in the chart, it's a little heavily weighted to consumer staples and industrials, but then has a solid mix of those other sectors in the economy. And besides that consistent dividend payment, the group tends to be less volatile compared to the market. These are older companies with stable cash flows and solid fundamentals. Management knows it has to meet that dividend payment no matter what, so the cash discipline forces them to make better decisions. And investors in the Aristocrats have done very well. This chart of the Dividend Aristocrats fund shows it keeping up with the stocks in the S&P 500, that broader stock market index, and underperforming a little bit recently. But the price chart doesn't account for dividends. That 8.6% annualized price return on the Aristocrats becomes a market-beating 10.9% annual return when you include dividends over the past 9 years. Now, only 7 stocks, Dover, Emerson Electric, Johnson & Johnson, Coca-Cola, Lowe's, Procter & Gamble, and 3M have managed to remain on the Aristocrats list since 1989. With 39 companies getting kicked off just since the 2008 crash. Now, companies don't all fall from the list for the same reasons, though. Besides a dividend cut, a company keeping its dividend constant without a raise is going to be kicked off, or if a company is acquired, like Wrigley's in 2008 or Family Dollar in 2015. We saw a lot of banks fall from the list in the 2008 crash, including Bank of America with its 30-year dividend history before the cut. And ticker BAC is now paying a 3.5% dividend, and once again, we see the banks caught up in crisis this year. That hasn't stopped Bank of America from keeping up with its dividend growth, though, with the payout rising 10% a year through the last 5 years. Now, Bank of America wasn't the only bank kicked off the Aristocrats last year. In fact, we're going to see one of my favorites later on this list, but BAC has still been able to produce a 9.8% annual return for investors since the financial crisis. Now, Bank of America isn't the best run bank, but it may just be the best balance between value and performance. The bank reports a 15.1% return on tangible common equity, that key profitability measure for banks. That's under the 20% ROTCE reported by JP Morgan, but that's reflected in the steep valuation discount for the shares as well. At a price-to-book value of just 0.85 times, shares of BAC trade for nearly half the valuation investors have to pay for shares of JP Morgan at that 1.48 times book value. We also see that right now, BAC is trading at a discount of more than 15% from its normal valuation, around 1 times book value. And the current dividend is just 7.5% of earnings per share, a ridiculously low payout ratio, which all but ensures that dividend growth can be maintained at that 10% annual rate for years to come. We still have 3 more fallen aristocrats to highlight, one with a 5% dividend yield. But finding the best stocks is pointless if you don't start with an investing plan right for you. That's why I created this quick 3-step guide to making your investing plan. Within 5 minutes, you'll be able to create an investing plan that makes your goals the motivation to keep investing, and that is customized to your needs. I'll leave the link below in the description. It's totally free, just something I wanted to put together for all you out there in the community. So click through and get your step-by-step guide now. I've seen too many investors miss out on the opportunity to make their money work for them, and it's because they didn't have a plan that fit their needs. So look for that link and get your free customized plan. Baxter International got kicked off the aristocrats way back in 1997, but ticker BAX still pays a solid 3.1% dividend yield. The leader in medical equipment cut its dividend in 1997, but has since increased it regularly, raising the payout by 8.9% a year over the last 5 years. Hospitals have been hit hard since the pandemic. Healthcare reimbursements from insurers and the government have not kept up with inflation, and a labor shortage in nurses has pushed wages up to the point that many hospitals are struggling. Now that's flowed through to lower spending for medical equipment makers like Baxter, but management has still been able to report sales growth in the first half and expects to report $3 per share earnings this year. That means the stock is trading for just 12 times on a PE basis, nearly 65% discount to that 5-year average valuation of 34 times earnings. It also means the payout ratio of just 39% leaves lots of room to increase that dividend without cutting into those capital expenditures. Now, Baxter has only produced a 6.7% annualized return since being kicked out of the aristocrats list almost 3 decades ago, but this is the second largest dialysis equipment provider and a leader in many of its markets. The valuation is very attractive right now, and shares should do well on an eventual rebound in healthcare. ConAgra Brands, ticker CAG, was in the Dividend Aristocrats for 5 years before getting kicked off in 2005. The company is a leader in frozen foods and snack categories, with market share position in several top brands. Now, shares of food companies have been hit hard by inflation over the last year. Here we see the gross margin fell by almost 4% in 2022 before rebounding, but it's still below its normal level. That has brought the shares down 16% in the last year, but there is more to like here than just that 5% dividend yield. First, the company's returned to dividend growth after that cut more than 15 years ago. It grew the dividend at a 10.4% annual pace over the last 5 years, and the payout ratio is still 51% of earnings. Not as low as some of the companies on the list, but easily manageable. Analysts expect 3.6% earnings growth next year to $2.82 a share, and the stock trades for just 10 times on a price-to-earnings basis. The food packaging segment isn't a fast-growing industry, but it's fairly stable and will continue to cash flow. Our last fallen aristocrat is one of my favorite stocks and has beaten the market since its fall from grace. But there's also something to be said for those dividend aristocrats that have continued to increase their dividends. In fact, those with the fastest dividend growth have done even better. Check out the video here for the 7 dividend stocks increasing their payouts faster than any other stocks on the list. JP Morgan was dumped from the aristocrats in 2000 and cut its dividend again after the financial crisis of 2009. But this is arguably the best bank to own and pays a 2.9% dividend yield. Now, that yield may not be much, but the company has increased it at a 12.3% pace each year over the last 5, the fastest dividend growth on our list. We saw earlier JP Morgan leads the industry in that return on tangible equity with 20% ROTCE. And the bank is one of the few to see its shares higher this year, even in that deposit crisis. Get your custom investing plan free with the link in the description below, or click on the video to the right for the Dividend Aristocrats growing their payouts faster than any in the group. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.